Welcome to Classic Value Investors and Microcap Explosioners. This is Mariusz Konieczny. This is the second video in the What is a Great Business series that I started. The first video was about Copart. Today we are talking about CoStar. I said before that when it comes to buying stocks, you're not just buying stocks, you are buying businesses. You are buying partial interest in businesses, and then you are paying for those businesses a particular price depending on where the stock market is trading. And when it comes to buying businesses, you have a choice. You can buy good businesses or you can buy bad or average businesses. And then within that choice you have, when it comes to good businesses, you can pay a wonderful high price, reasonable price, or cheap price. The same thing goes with bad or average businesses. You can pay a wonderful price, reasonable price, or a cheap price. The best combination that you can have is to buy good businesses for a cheap price. But even when you buy good businesses at a reasonable price, you are very likely to make a lot of money if you hold them for a long time. The worst possible combination is to buy bad businesses at wonderful prices. A lot of people will make money buying bad or average businesses when they buy them cheap enough, but I'm talking about the worst possible combination is to overpay for bad businesses. When it comes to CoStar, it is absolutely a good business, and at this point I think that it is trading at a wonderful price, and good businesses tend to always trade at premium. So they either trade at wonderful or reasonable prices. That's probably one of the reasons why I don't tend to invest in them, because it's hard for me to overcome that hurdle. And that's why when it comes to like microcap explosions, I look for good businesses that are overlooked and that are trading at cheap prices. But anyway, today the video is about CoStar, and like I said, it's a good business. It's trading at a wonderful price. So let's get onto it. So CoStar is a company that I was introduced to when I used to work in the commercial real estate industry. As some of you know, I started my career in real estate in 2003, and I became a residential real estate appraiser, and then quickly after that I became a commercial real estate appraiser, and then later I became a commercial real estate broker. So within a commercial real estate industry, whether you are a broker, banker, or an appraiser, you need data. You need data about properties for sale. You need sales comps, which is comparable sales, so that you can use to value or value the subject properties. You need lease comps. What lease comps are, let's say you have an office building, and what is the office building leasing for? So you need to know what other similar properties in the area are leasing for, and you need all kinds of data like this. And now CoStar is a company that provides this kind of data. And now, if you never worked in the commercial real estate industry in the US, you probably don't understand the significance that CoStar has. CoStar is pretty much a company that you cannot breathe without. If you don't have access to CoStar, you are dead, and there is really no competition. CoStar is like a monopoly when it comes to information for commercial real estate properties. Now, CoStar, so that's one side of the business. And then when I left the real estate industry, what CoStar did is CoStar also acquired Loopnet. And Loopnet is another company or a website that you can literally not live without. So let's say you are looking for properties for sale and you type in Chicago, Illinois, right? So it has all the listings. It's kind of like the MLS for residential, but it's for commercial. So obviously this website is used for people looking for properties, for brokers wanting to sell the properties, for tenants, for landlords. I mean, again, Loopnet is like the number one website for commercial real estate. So as a company, CoStar Group consists of the CoStar suite, which is what I talked about at first, all the data, sales, sales comps, leases, and things like this. Then they have Loopnet, which is what I just showed you. Then they have apartments.com. That's for, people looking to rent an apartment, and this is for the apartment owners to advertise the vacant units. And then they also have some other brands like bizbuysell.com, Landlords of America, and things like that. At first, when you just look at the operating performance, not everything looks fantastic. What looks fantastic is, for example, gross margins. Look how huge these gross margins are. Over 70%, and they reached 80% in 2019. Operating margins are also very good, over 20%, and they reached 26%. And then net margin is also fantastic. As you can see, in 2019 it was almost 23%. What doesn't look good on surface, and that's why probably some people might not consider this a good business, is return on equity, which is pretty low compared to a Copart, for example, that I showed you in the other video. 5%, 6%, 8.5%, 10%. Now, this is why understanding the business is such a key, because performance metrics like this are just a starting point that can give you clues whether something is good or not. When you look at the company's income statement from, let's say, 2019, you can see that the company generated $1.4 billion of sales, and it generated net income of $315 million. Now, return on equity is calculated by taking this number and dividing it by stockholders' equity. So when you do that, you only get about 10%, which is not bad, but it's not super fantastic. And then when you look at in more detail at the balance sheet, you will see that there is goodwill of $1.9 billion. What this tells you is that I didn't say this before, but CoStar doesn't pay any dividends, because what CoStar does with its cash flow, and when we go into the cash flow statement, you can see cash flow that's generated from operations. And when you go to the investing section of the cash flow statement, you can see what the money that generate is spent on mostly, and it is cash paid for acquisitions. So instead of paying dividends, CoStar is acquiring other companies, such as when I told you about Loopnet. And it is not in the financing section. It is not really spending money on dividends. Like I said, there's no dividends or buybacks because they think they can reward shareholders better by doing the acquisitions. But when you do acquisitions of other companies, and let's say you pay for them more than you can assign to the hard assets, you have to show the difference in goodwill. Okay, and now as I said before, the goodwill here is shown at 1.9 billion, and what that goodwill does is it increases the shareholders' equity by a lot, and that's why the return on equity is shown as kind of, you can say, artificially low. Okay, if you look at the income statement all the way from 1995, let's just look at the revenues. So notice 1995 to 1999, the revenues went from 2 million, 4.3, almost 8 million, 14 million, 30 million. I mean, fantastic growth. And then we continue from 2000, revenues went from 58, 72 million, 79, 95, 112, go into 2005, 134 million, 159 million, 193 million, 212 million. Then here was just a little drop in revenues. That was the 2009. They dropped a little bit, not much. Then 2010, growth resumed. 226, 252, 350, 441 million, 576. So as you can see, this is a very fast growing company. From 2015, 712 million, 838 million, 965, 1.1 billion, 1.4 billion in 2009. So think about this. This company went from 2 millions in revenues in 1995 to 1.4 billion in 2000. Net income went from, at first, which is kind of normal because the company didn't have any scale, it went from losing money, all of these years were losing money, and then it started being profitable in 2003 and continued to be profitable. Even in 2009 it was profitable during the financial disaster. Continued to be profitable, increasing the profits along with the increasing revenues. Here it had a loss in 2015, then regained profitability, and in 2019 it had a profitability of $315 million. Let's look at how the stock price reacted over the years. So from the beginning, as far as I can see, the stock price went from about $10 per share to, as you can see right now, a few days ago, it was almost, it's almost getting to $1,000 per share. So $1,000 per share divided by 10, it's a 100x, 100 bagger in the last 20 years. And now this wasn't an accident, okay? Again, the stock performed the way that it did because it's a fabulous business that the company literally has like no competition. It's like a monopoly, and it kept increasing revenues and profitability, which I just showed you. And as a result of this, the stock price reacted the way it did. So again, my message is the same. If a business performs well, the stock price will follow. When you're buying a stock, you're buying an ownership interest in a business. If you focus on what the business does, the stock price will take care of itself. The reason why I'm saying that CoStar is right now priced at a wonderful price is because if we look at what the company made when it comes to net income in 2019 is over 300 million. The company's market cap is, let's just call it $30 billion. So it is trading at over 100 PE ratio. Okay, you already know that revenues are about 1.4 billion. So it is trading at about 24 times revenues. Now, I'd say this is a wonderful price. I always said that I never bought CoStar before because CoStar was always too expensive for me. But as you can see, it didn't stop the company's stock from going as high as it did. Now, this is not a video about whether you should be buying CoStar or not. This is simply a video to show you what a wonderful business looks like, why it's wonderful, and so that when you look at other companies, you can at least think about whether a business is good or not, regardless of all the hype or valuation. So thanks for watching.